When you start analyzing a market's price action, and more specifically their swing points, which in this market they are repeated lower highs and lower lows, so basically a straight and simple downtrend. Nothing outcomplicated so far. But the problem begins when the market reverses. That reversal is seen with an upwards push that breaks above the last lower high, turning it into higher high. As most of you know, especially my regular viewers should know, is that when the market has been following a downtrend, and then after a long time, it finally breaks into a higher high, this first break is called a bullish trend shift. This simply indicates that the market has a high probability of now reversing the swing points, which would now form higher highs and higher lows. So knowing this theory, most traders, and especially the smarter traders, would look to buy this market from a support or demand, which is most of the times found near the swing lows. The placements of the stop loss has a proper logic, being below the demand. It has logic, because since you are now expecting higher lows, you're basically saying that the market should not break below the past low, but it should form the swing low, above the past low. And the logic of the take profit is simply respecting the uptrend fundamentals of repeated higher highs. Opposite as we've had before, when we've had lower lows. On uptrends we see higher highs instead, and we see the market pulled back into the demand or support, filling the order. But then we see this, a continuation of the downtrend, stopping us out of the trade on a loss. So the question is, what was the mistake? The reality is that very few have paid attention to the formation of the swing points. Look here, we have a low, but then we have a lower low after, and it's from this low that we have later seen the push into a higher high. The problem is that up until this point, we do have a higher high, but we do not have a higher low. The mistake was not waiting for the first complete uptrend formation to validate. What we should have waited for to validate a potential uptrend is to wait for a pullback that should later be followed with another break of the high. This upside break forms the break of structure, and that validates that this is now a strong higher low, which is later followed with a higher high. So now we have both swing levels pointing towards an uptrend, and it's only now when we can look for a demand or a support level near the past swing low in order to take this market higher with a buy position. In this market, the moment we've seen the market breaking below the past low, that's when every bullish scenario should have been ended, since we do not have both a higher high and a higher low in order to sustain an uptrend. Now here, we initially got an uptrend, with pretty clear higher highs and higher low formations, from where on each higher high we validate bullish breaks of structure. But it then fails to form a higher high, and actually forming a lower high, shortly followed with a lower low, this breaking down into a bearish trend shift. So this time we actually had both, a lower high and lower low, so we got both characteristics of a downtrend